Kit, there is a view here that ultimately this bond market has barely sneezed yet, that at 520, that's not a major issue. That's hardly significant bond market pushback. Kit, which begs the question, what do you think is motivating the Treasury to act this early, this quickly, to intervene?
Well, part of it in my mind is that they want to keep control of it, and so far they're not doing anything very much. I mean, let's remember this is management of the market rather than yet something that you might call intervention in the bond market. So, we'll have to see how it goes. I tend to think they're sending me a fairly clear signal that they'd like a weaker dollar. I think that's the signal that I'm getting from them that doesn't suit my forecasts or my assessment of where their economy is, but they've been successful at that. So I see this as just another way of getting a stronger yen, a stronger euro, a weaker dollar.
That's where the adjustment you'd think would have to take place. Kit, you called it a global problem. The dollar's a relative story. FX is always a relative story. Is pushing on the dollar the right way to deal with this from an investor standpoint?
It's a way, and I certainly think that it's probably something that suits America. It doesn't solve the problem for everybody else, but the dollar is overvalued on sort of long-term fundamentals. So it's not the dumbest idea to be pressing on the. At least I'd prefer you were trying to push the dollar down than you were really trying to rig the Treasury market, which seems to me quite dangerous. But this is a policy the United States have. They've got the world's best economy of the major economies, and they've got the strongest currency, and they don't want the strongest currency. This is a way of doing it. I would view it more that way. It's difficult. It's difficult to navigate what it means going forwards from here. But they have a challenge if the rest of the world is going to be less keen than it used to be to hold quite as many U.S. assets.